Welcome back to Real Estate Mindset. The housing market crash is unstoppable. And if you want to know what's going to happen next in the housing market, then this is a video that you may want to pay attention to. Now, I have Melody Wright with us today to help talk about why the housing market crash is unstoppable. Now, on top of Melody being my colleague who travels around the nation with me state by state, housing market to housing market, to give you guys data and trends that mainstream media isn't, she also provides expert commentary and analysis on the economy and on the housing market. And so if you guys like what she has to say, please don't forget to go to her Substack, Melody Wright Substack. This is absolutely wonderful information. She just had a report go out a couple days ago titled Exhaustion. I'm sure you guys can relate with that. Now, she has absolutely elegant, if not enchanting writing, but she's also super heavy on the data, talking about average household size, children living with parents. She's talking about multiple job holders, cancellation rate. She has so much data. So again, you guys, if you want to support her, subscribe to this. She has overwhelming data. And before I give the mic up to Melody, I want to let my viewers know that I understand whenever she's on the channel and I'm talking and she's not, you guys roast me in the comment section. So I'm going to zip my mouth. I'm going to let her sing, but primarily because I really want you guys to pay attention to what she has to say. Melody Wright, how are you today?
I'm doing well, Travis. How are you?
I'm well. I really appreciate you being here. I'm humbled by your presence, Melody.
Well, thank you for having me, Travis. It's my pleasure to be here.
Yes. So I want to get started with a question that I've asked you before, and something I like to start out with before we really jump into why the housing market crash is unstoppable. Can you explain to the viewers what your opinion is of a housing market crash? What is that?
Well, it's a correct. So I often say correction, but a crash really would be, in my opinion, if we kind of come down from here very quickly, similar to the way that we went up. If you remember, it was absolutely bananas. How quickly prices went up during the COVID boom. So a crash to me would be honestly, if we have a huge price decline in a very short amount of time. Right now, based on what I'm seeing, I think we are going to have a very large correction, and it could take several years to play out. But I got to tell you, just as they went up that quickly, there is a possibility they could come down that quickly as well, although that's not my base case.
Okay. Now, Melody, can you start with explaining why essentially a housing market crash or extended correction, I think as you would prefer to put it, is unstoppable?
Why is the housing market crash unstoppable or correction? Because honestly, Travis, we've just run out of gas. We've used the housing market to try to juice the economy really since the late 80s. But you can look back, if you look at the graphs and look at what happened, you can tell that we never in the COVID boom got as many sales as we did during the run up to the GFC. And so each time they tried to use housing, it's like less and less steam. And so honestly, folks have they've reached their limit. You look at the chart of median income to median home prices, and it is much higher than during the GFC, and it's insanity. People want to talk about rates, but in fact, rates have averaged 7.71% since 1971, mortgage rates, that is. And so what has really happened is that home prices are now so far out of reach for your everyday American. And sure, the top 20% do 50% of the consumption, but there's a limit to how many houses they want because honestly, right now, it's just an albatross. You can look in all of these markets, luxury is sitting and growing because these property insurance taxes, it's ridiculous and it's unaffordable. And rich people don't stay rich by spending stupid money. And so there are no people to come in. The investors are net sellers. There's still a few mom and pops investors that are a bit delusional, but there's just no one coming for the housing market. And in fact, Scott Turner he stopped the most egregious loss mitigation program for FHA. That will be ending October 1st. And so it seems as if the administration also is not going to stop what's happening, unfolding in the housing market, which is, we've got inventory piling on, as you and I have been trying to tell everybody for almost 2 years, that the inventory is out there despite what everybody else says. And so at this point, I think this is just beginning. I think we're in inning one of inventory growth. And I think people are going to be very surprised how much inventory comes to market in the next few years. And so I just don't see what could stop this housing market crash. If rates go down, that just means more inventory is coming to the market like it did last summer. And guess what happened? Prices went down. And so, rates are too high. People can't afford these homes. We had the most cancellations of any April, besides, I think, in April of 2009 or something like that. And so people just simply cannot participate in this housing market. And I think you're starting to see a real buyer strike. They're refusing at these prices. And at the same time, distress is building in the consumer. And we've got more delinquencies, which, I'm seeing distress sales already in my client books.
Yeah. And honestly, I hear you with the strike, right? Like, yeah, so there's people striking, but to be honest with you, Melody, they can't afford it. Even if people wanted to purchase a house right now, they just can't qualify it for it. So I certainly agree with what you're saying. We have the housing market, it's toxically over leveraged. Prices skyrocketed at the same time where income stayed the same. Hopefully there's no more kicking the can down the road. I mean, income, right? We can look at income, we can look at price growth, we can look at inventory skyrocketing. There's no demand to absorb it. Obviously, prices are what's next, right? That's the elephant in the room is home prices. So can I ask you, Melody, now I often see you on X, Twitter. I don't know what we're calling it now, X or Twitter, and you're pretty active there. You're obviously a great writer, but you have your, hands to the pulse of a lot of what these financial gurus are saying. So I'm curious, can you share with us what some of these more bullish housing market analysts are saying? And like, why are they saying the housing market's not going to crash? Like what,
I think there's only one of logic. Yeah, I think there's really one of those left standing. What you have is your industry analysts are coming out and saying, oh, we think there's going to be a modest decline this year, a modest correction, because, what else could they say? They've been saying that it wasn't going to happen for 2 years. And so now, as it's happening, they have to kind of pivot and they have to save face at the same time. So it's like, oh, we think it's going to go down a little. And I really think there's only one real housing bull left out there. I'm starting to see everyone pivot to price declines. And so I personally, though, they still don't have it right. I don't understand why because they still believe that we're structurally undersupplied.
We got 15 million vacant homes right now. We have
plus 3 million. Yeah, plus 3 million seasonal homes.
And 8.1 months of new homes that are being reported. Right. So,
and 4.4 of existing that are being reported because we know there are pocket listings. So, yep.
So I try not to waste my time listening to nonsense anymore. I mean, I'm a father, I'm a husband, just like you, our time runs thin. But from what I remember, really, the bulls that were predicting the housing market, all they were saying is Fed put, like if house prices go down, then they're just going to bail out the market. And we're like, well, if they bail out the market, it's not really going to do anything. It will potentially kick the can slightly down the road, like the bank term funding program, but it's maxed out. The system is at max capacity. Income's not going up. We see private equity issues, skyrocketing bankruptcy there, commercial real estate, investors can't make any money on their money. So, I mean, has it changed out of that narrative? From the last one standing? I mean, do they still think that the Fed, some magic way is going to be able to fix the housing problem in a way to where everyday Americans can afford a house? I mean, what do they say to that?
Yeah, I think they do think that, but I don't understand that because the Fed bought MBS back in 2008. It didn't stop anything because it was too late because the consumer was simply crushed. And that's what's happened now. We now are seeing the bodies floating up to the surface in terms of credit quality. A lot of these private credit they were funding these fintechs that are giving out these home equity installment agreements, all these, fancy home equity products, which some of them are not being recorded on public record. And so, we suddenly now with loans finally reporting to credit, we're seeing that the consumer is very distressed and much more distressed than anyone thought they were. And with that 41.8% mortgage refinance rejection rate that the Fed saw in February, access to credit is being shut down. And these people were living on borrowed time. They were living on buy now, pay later. They were living on their credit cards. But you and I both know, Travis, what happens when you live on your credit card. You pay, and then the interest is so much each month. You're kind of getting further behind if you have a balance. And then pretty soon you don't have room on your credit card. And so you have to figure out some other way to buy groceries and things like that. Well, enter buy now, pay later. Now they're reporting to credit. And so that means that they're having to deny many more people. So it's getting really, really dicey out there for the consumer.
You mentioned that you prefer not to say crash, you prefer to say an extended correction, but being just how elevated and detached prices are from income and important sustainable things like that. Can you go into how long do you think that this will take to play out? Probably half a decade, right? How long will this play out? And how, from a nominal standpoint, so not counting inflation, just from a nominal standpoint, how much decline can you see from start to finish of nationwide home prices nominally going down from start to finish?
Yeah, so I don't have an exact percentage that I would say, but it has to correct to the point where people can afford it again. And so that could be like almost 50% or more. I mean, we just simply cannot sustain these price levels. So, it would be amazing. It's going to hurt a lot of people. And so, I'm not going to take joy in that. As you know, I don't. But it would be amazing if home prices came down just as quickly as they went up. But we have to get to a point where our median income can sustain and maintain that home price.
Yeah. And Melody, how long do you think this could take to play out? Some would say the global financial crisis that played out to right now. I mean, they did another round of quantitative easing in 2012. So global financial crisis in 2008, they do more quantitative easing and bailing out in 2012. I mean, it took a long time to play out, and it's still playing out right now. So how long do you think this could really take to play out and to kind of normalize again?
I've really started to look at this as one cycle, really since the 80s, and this is kind of a double top. I think that honestly, Travis, I think the housing market is going to be changed forever once this correction starts because of the demographics. And very similar to Japan right now has 11 million vacant homes out there. A lot of U.S. citizens are going to buy them because of their aging demographics, and we are right there with them. And so it could be that this correction takes 10 years to fully go to the floor. But after that, I think the housing market is going to go back to being what it's supposed to be about, shelter and not speculation.
Right. That's exactly right. And it's a pity when you think about how our households have been robbed. I mean, the family's been robbed, our culture's been robbed and leveraged up. The dream of home ownership is a toxic liability now. That's what it's turned into, at least over the last 5 years. Obviously, we want people to own a house, and I'm going to get to some questions about when are you going to own a house. But I want to kind of pivot a little bit, because one of the primary reasons to the points of the people that used to be bullish on the housing market, to their point, if the housing market goes down, say just 10%, if it goes down 10%, the amount of money that is trillions of dollars. So for the financial market to take a 10% hit on collateral that's highly leveraged, that we don't know, 20 to 1, 10 to 1, we don't know how highly leveraged this stuff is. Can you explain how just a 10% drop, how does that impact the health of the financial markets?
Well, unfortunately, it's a huge impact. And you'll start to, the way that the housing market works through securitizations is the machine has to keep running. And when the machine starts slowing down, then you have severe issues on the back end. It's not, everybody knows that mortgage-backed securities, especially the Ginnie Mae, theoretically, they're going to get paid. They will always get paid. Um, However, it's about the appetite on the upfront. And as people start to understand the bad collateral and really what this housing market has been about, then your appetite for MBS is going to go down. Once that happens, because these things are used to be pledged all over the world because they're seen as very safe assets. And so they use these to pledge to get liquidity. And when you suddenly don't have enough of them to pledge for liquidity, there's going to be a system shock. And really, this is what happened to Lehman. Basically, Chase just said, "We don't believe you anymore. We're not gonna let you borrow anything." And so, I believe that we are gearing up to some sort of systemic credit issue that might actually start in auto, although it really should start in commercial. But they are working so hard to keep that commercial from crashing because the banks are exposed no matter what anyone tells you.
Yeah, the banks are bankrupt. They're insolvent because of the derivatives market and the
Right.
over leverage and the greed, corruption, and fraud. Melody, so if we get a 10% drop, it's going to put a tremendous amount of turmoil on the financial markets. We're probably going to see a stock market crash. America's going to freak out because their 401k drops 30% when they could have been investing in something like gold the whole time and had 280% increase versus their 40% increase. So what little they have gone up, which 401k is an embarrassment to America, it's a failure. It's going to go down. It's going to freak people out. And I'm worried, and this is probably going to happen, they're going to take that fear, they're going to polarize the fear that America has their 401k, even though it's absolute garbage to begin with, and they're going to print money. They're going to try to soften the blow. Can you articulate what you believe? First of all, I think we can both agree that there's going to be money printing coming up. Would you agree with that?
I think so. I mean, that seems to be the most likely outcome, but we're getting to a point where that just doesn't matter. I mean, it just
Right.
doesn't matter. And so they can do what they want. The consumer, until we have higher paying jobs, right now, what's happening? Layoffs are increasing, bankruptcies are increasing, and a lot of those white collar jobs are going away due to AI. So, really, the only way the housing market gets saved is if we have more higher paying jobs that can afford these prices. But I don't see that coming. I don't know about you, Travis.
Well, I mean, do you see a situation to where, say, over the next year, that the average American, their salary will go from 81,000 to double that to 160,000? Is there any realistic way that can happen, Melody?
I don't see that, Travis. I don't see that at all.
I don't think
I mean,
so.
you look at what happened. So we talk about the money printing. We talk about, oh, they can just, they can cover it up. Well, as you and I know, having spent a lot of time here in this area for Helene and out in LA with the fires, those people aren't getting any checks. And if you were going to save anybody, why wouldn't you be sending them checks? And so I don't think they can print, but it's not going to help. It's not going to help. It'll help those top 10% asset holders. It's not going to help anybody else. And in fact, I think we're getting to a point that people understand why home prices are this high, and they know it was because the Fed bought MBS. And so I think there will be anger, lots and lots of anger if that actually happens.
Yeah, I mean, because people are starting to wake up. And it's been surprising how long it's taken, for them to wake up. So, what we've talked about, obviously prices are softening nominally on a nationwide basis. Several data providers, including Redfin and Zillow, are now forecasting price decline this year. We have inventory skyrocketing, still bifurcated housing market. We have all of these things happening, right? Big one being inventory. Another big one being America's waking up to like, hey, what happened? And oh, wait a minute, buying a house can actually be a huge liability. You don't use your emotions buying a house. If you do that, you risk bankruptcy. Use your emotions, risk bankruptcy. Use the math, you could potentially make some money on it in the future. Right. So, Melody, can you explain, what would need to happen in the housing market and in the economy for Melody Wright to say, all right, it's time for me to go buy a house? What would need to happen?
I'm to a point, Travis. No, this is going to sound crazy to a lot of people, but I'm to the point where I just don't want to take out any debt. I don't. And so a couple of things need to happen. One, I'm on a property that I absolutely love that has 13 acres and I think has a ton of potential, and I want to buy this property, but I need prices to be a little bit more reasonable. This house is very old, so I'm not really buying this house because I will have to build here. But I will have to have more reserves before I do that. And I know it sounds nuts, but I would really like to be at a point where I didn't have to take out leverage. Now, that doesn't mean that I won't pull the trigger in a year or so from now when prices have corrected. And I can hopefully keep my job of, writing and my clients and things like that. But at this moment, those with leverage are going to be hurt the most. And I am just so grateful and thankful that, that's not me any longer.
Well said. And Melody, can you talk about, for the people that are on the sidelines that are either forced on the sideline, which is most people are forced on the sideline. There are some people like me that are choosing to be on the sideline, protecting our purchasing power. And it has been very difficult to protect my purchasing power. Very difficult. But I am, right? Like I'm getting beat up though, Melody. I'm getting beat up. My purchasing power is getting beat up. There's no doubt. But what can you tell the people that are on the sidelines right now? And say most of them are discouraged and confused. What should those people be told, and what should they be paying attention to?
Just, number one, like anybody that's trying to sell you this narrative that you have to buy a house now, think about their vested interests and why they're saying that, because their paycheck depends on it. But think about your paycheck and think about what would happen if you are a dual income household and one of you loses a job. But then think about what happens to your relationship because you're so stressed out and you're fighting all the time. You're seeing it all over social media, this regret over purchasing because people are stressed because they don't realize, like you and I have talked about several times, houses, things break. You have to fix them. You can't, anecdotally, I'm going to give you an example from someone in my own life who just went to do a mortgage refi. And the appraiser came in and noticed a whole bunch of things that the appraiser did not notice when he bought that house originally. And guess what? It came in $20,000 less, and he was not. He couldn't qualify for that refi because of the loan to value.
What do you think the main data set that these bulls over the past 3 years missed? Like, what's the one thing that these bullish people got wrong, like the one data set they refused to acknowledge? What was that data set?
Well, I want to, if you don't mind, can I share a slide with you?
Yeah, sure.
Okay, so I think they missed the entire economy, I would have to say, Travis. They just, they look at things like the unemployment rate, and they look at what's called U3, and they don't look at U5, which is the entire, people that could be working but aren't. So I think that they missed, and tell me if you can see my screen. This is the existing home prices and median household income for both existing, the graphs here are existing and new. And you can just see that things got completely out of whack, even more out of whack than during the GFC. And so they miss the economy. They miss what's actually happening. And they used instead, just headline numbers, mainstream media, just pushing very low unemployment. But another slide in here that I'll show you is we're at, the highest point of multiple job holders where both of the jobs are part-time ever since this series started in 1994. So that means that people are working 2 jobs because there are no full-time jobs available. And so I just think they live in bubbles where everyone around them is exactly the same, and they're the elite. And so they don't know people like me, and they don't know people here in Johnson City, Tennessee, and what they're going through. So they just believe that, and they believe the numbers about the equity, which you and I have talked about ad nauseum, that something is not right out there, and there's not the amount of home equity they believe.
Yeah, I mean, I would agree with you. Big one, income. Income, right? Like, someone's got to pay for this, and those someones are called Americans. Ever hear those people? And then the other thing is the data integrity. Golly, the data integrity is so bad. I found a few days ago, it kind of like hit me. I'm like, wait a minute, why have I never mentioned this before? Do you know that according to Fred economic data, real median household income is the same as nominal median household income? That's how blatant the lack of data integrity and reliability is. There's no possible way that both nominal and real are the same number unless there's no inflation. But one thing that we know is this problem is in existence because of inflation. So the data integrity is, it's bad, Melody. My God. And we've seen them change the data multiple times. Can you go into, like, how do you think that they're getting away with this? Like, not enough people care. I mean,
yeah. So, you look at non-farm payroll, and I was just reading something from Danielle DiMartino Booth today, that's gone down to a 35% response rate. I mean, the data integrity is so bad now. And honestly, Travis, after living in these numbers for the last few years, it absolutely feels like there's some monkeying around. I was able to say very clearly that the builders would have to revise their price up, and the existing home NAR would revise theirs down, and they did. Why? Because of the optics. And so I am at a point of watching these numbers that I don't think I believe them anymore.
I know. That's why, we used to get excited, like, oh, this new data set's going to come out. Like, we're just so, like, couple naive high school kids, like, yeah, the data's coming out. But, every time you get hit in the stomach, I was, another hit, another revision. It's just like, I can't do it anymore, man. Like, I can't be that idiot anymore. I can't be the useful idiot getting excited over data that's manipulated and the inputs are fraud. I can't do it.
Yeah, so June of last year killed me, because that's when that NAR peak happened, and there was no indication that should happen. It was wild. And so I think, it's going to be very fascinating to see what June numbers, because June's always the peak theoretically of the selling season. And so Travis, they would have to work very hard to meet that June of 24 number, especially with new homes. They're in the toilet, new home prices. So they're in a corner right now, and it's fat. And like you, I track the data religiously. Don't get me wrong, but I don't get excited anymore. And I watch the narrative more than anything else. And the narrative is hilarious and bizarre and strange. When you have someone like Realtor coming out and saying investors are selling due to distress, you read the article, there's no mention of the distress, but it's just, that's okay. Yeah. They want the headline. They're trying to tell everyone, hey, you can come back in. Prices are coming down. And they hope to get you in there, but don't fall for the FOMO of falling prices either. That's like catching a falling knife.
Yeah, absolutely, Melody. So what do you see happening, say, over the next year in the housing market?
Wow. So I think, there's so much going on, but I can tell you, I just pulled delinquency from my client books, which has been tracking the national statistics pretty well. And we had a 50% increase in 30 plus delinquencies year over year, and 160% increase month over month. Okay, 160% increase. And so, and I'll get to your question. I expected that in June, Travis, not May, because typically you're still kind of coasting along on your tax refund, your bonus payment. But if those numbers, I'll be able to pull the national numbers here in the next couple of days. If those numbers are true, then we are starting to see real distress right now. Now, what will happen to those people? Likely, if they're new 30 plus delinquent, they will go into some sort of loss mitigation program. But come October 1st, if they have delinquent student loans, they will not be eligible. And so one of my colleagues, John Comiskey, has done great work on what these numbers look like. But you're talking about, and we all know it, well, we don't all know, but it takes 120 days to refer a loan to foreclosure. And so basically by Q1 of 2026, I believe we are going to have a significant foreclosure portfolio, which, as you know, that was really never part of my thesis. And that's even more concerning because you essentially are going to have all these distressed sales out there.
And Melody, can you explain to the viewers, like when you say, because not everyone knows this, right? Like when Melody says she's in her client books, explain to the viewers, what do you mean by that? Like, what are you looking for? What is your job managing these servicers' money?
Yeah, so I do something called subservicer oversight where, after the GFC and the consent orders, you have to really, any vendor that you use in banking, you have to monitor like crazy. And so I look in and I see what's going on. And a little trick I learned from the GFC when I was at GMAC and had over 65,000 foreclosures that I was managing is I do loan level reviews on a sampling. I always do, because that is how you absolutely understand what's happening. And so each month I do delinquency reviews for my clients to let them know what happened. For instance, and one of my clients were about to have a foreclosure sale June 12th yesterday, and went in to look at that, and they paid off. Someone came and bought that property, because if that one had gone to sell, Travis, it was kind of crazy. It was appraised at like 350,000, but the total debt was only 99,000. So that's and as a servicer, you're required to only bid total debt. And so that home would have been sold at $99,000 versus $350,000. Can you imagine what that does to your comps?
You got to ask why these people aren't selling. I mean, seriously, why? I mean, if someone has $250,000 in equity, it's got to be a mental, or something's happened in their life and they're just not capable of navigating the turmoil. I mean, you see it happen with senior citizen in these tax liens. They got $500,000 in equity, but they just don't know how to fight the tax lien foreclosure, and they lose their house.
Yeah, it's nuts. And I mean, I got to be honest. I've been helping some folks who have issues with properties in distress, typically inherited properties. It's amazing to me just how appreciative they are, because I know the lingo, I know how to talk to the servicer, and people they really don't know what to say, what to do, and they're very overwhelmed by it. So if people need assistance, let me know with that as well. Just reach out to me.
Okay, I appreciate that. And, just for the viewers know, all of Melody's information is going to be in the description of this video, and the ending link in this video will be to her Substack. Just one more question, Melody. Now, this is a question about your career, okay? Because I've been wondering this. This is a surprise question. I've seen you on Fox News. I've seen you've been going down to New York. You're hanging out with all the cool kids. You got your Substack. You're doing well in Substack. You're flourishing. I wish I see you all over YouTube. You're making some big moves. You've been a voice of reason. You've been really refreshing to listen to and to hear articulate what's happening. What's next in your career? What are your plans for the next 5 years? What does Melody Wright hope to do with her career in 5 years from now?
Whatever God wants me to do, Travis. I'm just listening to him. So wherever he takes me. But, honestly, right now, it's about getting the message out. It's about giving people hope. I know that everyone thinks, actually, I'm a doomer. And all I care about is bad news. But in reality, I care about giving our younger generations hope, because right now they are very they don't have a lot of it, and they feel very lonely and anxious, and And so I hope that, through these changes, because during hard times, I think, and this is something I kind of wrote about in my last Substack, is it can actually bring people together because you're not so hell bent on taking that, doing that experience vacation to get your Instagram photos. Instead, maybe you have to move some family members in. Maybe you have to help people. Maybe you have to feed some of your family that can't eat. And so it brings people together. And I'm hopeful for that because we have a lot to heal from. And I believe, as you know, that we've been in a silent depression since 2007. And in reality, GDP has been going down since 2000.
I want to give you the final words. If you can close us out, what would you like to say to the Real Estate Mindset viewers?
Just hold on. You guys have been watching and waiting and praying and hoping. And it has seemed like forever because it does take forever in housing. And I think that, you asked me what everybody missed, Travis. And the thing that I forgot to say is they miss the speculation. People don't understand that housing as shelter is no longer the game out there. It's a casino. And you can look at like the coast of San Diego, where we were in Mission Beach, and it's just dots of Airbnbs. I mean, basically homes were turned into theoretically income streams and weren't really considered shelter. And I think we have to get there again.
You guys, one more time, if you like what Melody had to say, her perspective, what she's talking about, how she's articulating things, don't forget to go to Melody Wright's Substack. Subscribe to her Substack. It's not that much money. Support her. And we will continue to go around the nation uncovering truths and data that you're not being told mainstream. And other than that, guys, if you're out there investing in real estate, you guys already know we wish you luck and we hope you win.